Good afternoon and welcome to our webinar on equity, the key to unlocking a sustainable economic recovery. My name is Rainer Ries and I'm the Director General of FESE, the Federation of European Securities Exchanges. And I think all of you obviously know this, but the COVID-19 pandemic has had tremendous effects on our societies. The loss of life is currently counted in hundreds of thousands and the number of confirmed cases in millions. And I think our societies have closed down to limit the spread of the disease. Economic activity has ground to a halt. And a secondary effect may therefore be to produce the most severe economic crisis since the Great Depression. But I think as the COVID-19 virus has started to spread throughout the world, the impacts on the real economy through lockdowns and other measures are just starting to unfold with unprecedented magnitude. Markets have been resilient so far, despite high volatility and this constant strong fluctuation of valuation and liquidity. But we need to address, obviously, the economic crisis at hand, and that's why today Accountancy Europe, the CFA Institute, FESE, and the European Bank for Reconstruction and Development issued a press release which has the same title as our webinar today, Equity, the Key to Unlocking a Sustainable Economic Recovery. And you may be aware that this group already launched the IPO report on the 2nd of March at a time when the full extent of COVID could not yet be foreseen. And since then, all findings and recommendations, I think, have only gained in importance. Also, the high-level forum of the Commission on CMU has issued its recommendation, and the CMU action plan is currently finalized. And we felt it's our duty as European citizens to contribute to the European recovery and really seize sort of this crisis as an opportunity to revisit and improve economic policy and create a better and greener future for Europe. And certainly the post-crisis world will be built upon the choices we make now. So it's very important for us to look at that. And I think that's what the objective of this webinar is. Let me just briefly set the scene for today's seminar. I would ask all participants that are on video to switch their video off. I think that's Daniel Tinder, Gottfried, and then I cannot see the name right now, but if you would be kind enough to switch your video off so we only can see the presenters, that would be very good. And let me just introduce the speakers of today in the order they will speak. The first one will be Josina Kammerling, Head of Regulatory Outreach for CFA Institute for Europe, Middle East and Africa. Tatiana Panova, Head of Unit, DG FISMA for the Capital Market Union. Piet Heemschutter, Regulatory Affairs and Capital Market Leaders at Ernst & Young, Belgium, representing here Accountancy Europe. And last not least, Hannes Takas, representing the EBRD. I should say congratulations to you, Hannes, as you've just been appointed as the new head of EBRD in Mongolia. But we're very grateful that despite of your new role, your passion remains equity markets and how to develop capital markets, and that you can join us here today. And without further ado, I would ask Josina to start, and again, everybody to go off their cameras, please, so we can only see the speakers. And there is Vlad, I think, who still has his camera on. If you could possibly switch it off. Thank you. Josina, the floor is yours.
Thank you very much, Rainer, and it's a real pleasure to be with all of you today. CFA Institute did a recent global survey on COVID, which we named, I think rather aptly, "Is Coronavirus Rocking the Foundations of Capital Markets?" And indeed, we are in unprecedented times, and as Rainer so clearly said, this group has been working since autumn 2019 on an IPO stimulation task force recommendations. And we felt very strongly that COVID was such a black swan event that it needed additional thinking on our part. And also the aim of this group is to continue to reflect. So this is not a one-off high-level statement. We will be continuing to reflect on how to stimulate equity and indeed capital markets in general. And there I come, of course, to CMU. CMU started in a very discreet way, and we all recognized when we had our first round of discussions with the task force that CMU needed to be more ambitious. And that, of course, aligned with the high-level group was a clear indication that there is a need for a capital market in the European Union, a capital market union. However, it is always difficult to talk about what is the capital market, because our continental market is, of course, a cluster and groups of capital markets. And of course, the EBRD and the stock exchanges have ample knowledge of this, clustering together groups, but also national initiatives. So how do you stimulate a capital market to more slowly and take up importance and build a cross-border wide market that is open for investors? How do you address all the differences? And of course, with Accountancy Europe on board, it is normal that we also look at tax issues. Tax remains an elephant in the room. It is something that does need to be addressed at some stage, whether it's the debt equity bias, whether it's withholding tax. We all know these problems. We all know, and we're not a federation. Europe is still national member states, so it is difficult to find ways and means to stimulate any initiatives on tax. And of course, this then brings me to the barriers. We know that Europe has many SMEs, and they tend to be smaller rather than larger SMEs. So they're still very often in the very initial stages of that escalator to getting themselves on the public markets. Again, COVID-19, the first reaction, of course, was to give debt relief. And banks were very important in this. Debt was the very first sort of, I would say, Hansaplast measure to help these SMEs and to help companies face the unprecedented demands that they have been seeing. However, equity is a long-term solution, and there needs to be a balance between debt and equity. And this is something that all of us in this task force, we have been seeing that it still lacks a strong equity culture. And we have discussed in our original task force report, we discussed about educating investors to focus on equity. Providing an equity culture, as many people have said. So again, it's important to look at the barriers. The barriers for SMEs, of course, are this access to finance, but in the original report, and again, we have reiterated, we need to, not with all the regulations that we have in the capital markets in the EU, not to have unintended consequences. Some of the unintended consequences are on SME investment research, which is currently one of the discussion points in MiFID. So there are manifold barriers, and we need to be behind innovation, making sure that innovative companies can grow into their stature and that they don't disappear off, for example, to the United States, as has been happening. So we have these measures. We have seen also with great interest work is being undertaken at the EU level to create a fund to support IPOs. And Ursula von der Leyen, of course, in her statements has indicated the keen interest to support SMEs. We feel it's important not only to support IPOs in this, but also to support secondary issuance. Again, it's important to provide that liquidity, to stimulate that liquidity. This crisis has shown that liquidity has at times been stressful. But again, what was interesting also is that the exchanges remained open and remained fairly, I would say, in control of making sure that there was enough to keep the markets going. Whereas we've seen, of course, problems in the unlit, in the dark parts of the market. And again, that is all about developing a capital market that has both unlit and lit segments, but that also has private private and public capital markets, there should be a balance. And this balance, finding this balance, is the concern of all the partners. Market liquidity, of course, has been impacted. But again, it's been interesting to see there has never been a stop in trading. But again, we need to be conscious that there are several smaller markets and that we are not out of, let's say, out of the weeds. So we do need to keep measuring and controlling and making sure that liquidity stays there. So these were some of the main points, I would say. Again, tax was a really particular tension point, and we really hope that both the member states and at the EU level there will be more debate on how to circumvent sometimes, very normal these national measures. So this was in short where we're coming from. We will be giving our own particular views from our own institutions after Tatiana's recommendations and from what she has understood from our high-level statements. So I now give the floor to Tatiana. Thank you.
Yeah, Tatiana, maybe to briefly introduce, I think in my view, Capital Market Union probably is now the game changer, which maybe people haven't seen that way earlier this year. But I think the Council certainly has given it a higher priority by setting up its own high-level group and having worked and giving recommendations. Now the Commission has run its high-level forum and obviously working on the CMU action plan. So it would be very interesting to hear from your perspective, what are the key priorities we need to get going in order to make Capital Market Union a game changer and something that solves the problems for recovery?
Thank you for the introduction, Rainer, and good afternoon, everyone. It's quite ironic that we needed a crisis for us to realize that Capital Markets Union is actually a game changer. I think many of us already have already come to this conclusion quite some time ago, and all of the buzzwords that we hear today, the need for equity, the need for long-term investment, the need, to have more retail investor participation, all of those things we've been talking about for the last 5 years. How important they are and how focal they should become to the policy reflection and to the political discussion. Now, of course, the crisis brings along misery, but it also brings opportunities. So as some of them say, we never get a good crisis get unused. So let's use this crisis in a good way, in a sensible way. And what I mean by that, I think there is a reality. There is, I think, an overall understanding that debt and grants and loans and public support, fiscal, monetary, all of this is extremely important. I think it's key. I think it's key to fix the short-term needs of companies that are bleeding liquidity. So that is clear. At the same time, I think what is also clear, it cannot be a long-term solution. So companies need to get to a sustainable way of funding themselves. And debt has a maturity date, debt has an interest. All of this would really hit the companies fairly soon. And I think what is essential is when this realization comes, to enable companies to use equity when they can, when they should, and perhaps equity is a bit of a broad term, but to use all types or all permutations of equity that we have, both private and public. And public is, of course, is extremely important because there is transparent trading, because there is price formation, and because you can actually come back and seek more equity through secondary issuance. So all of this is extremely important. I think we were fairly happy to see that the Capital Markets Union has got a new traction. I think, Rainer, you did mention the council work on this. There were council conclusions. Of course, the Parliament is now coming out with their own initiative report that I understand will be adopted in September. So I think it's good that all legislators, policymakers are putting their heads together to try to understand, what it is really that needs to be done. I think the high-level forum report was extremely timely. I think it came out with a lot of very precise ideas, which I think we have been perhaps lacking, at least from policymakers and the reports that we've seen. I think lots of statements that we could, wholeheartedly agree with, but having read certain things, often you had this aftertaste, wondering, okay, yes, I agree with the statement, but how do we get there? So I think the value added of the forum was to tell us, exactly how the forum believes that we should be getting there. Some of the things are fairly ambitious. Some things are extremely ambitious. Some of the things were so polemic that they couldn't agree on, because of course you have a variety of views, and these things concerned also discussions on supervision, and some of this actually trickled down in press. So there was quite a lot of attention given to the fact, whether supervision and more centralized, more convergent supervision is essential to the establishment or to the creation of a single market for capital, or not. So I think what needs to be done now is perhaps a very sober reflection on, how many or perhaps all of these recommendations are absolutely essential to then being put on the table. And of course, it doesn't stop there. I think what is essential is for the co-legislators to then agree on them. And in that, I think what is key is for the key legislators to maintain a certain degree of ambition, certain degree of, I think, alignment, if you wish, with amongst all policymakers, that in times of crisis, very ambitious things are necessary, and sometimes it might come at the expense of ensuring perhaps a slightly better, slightly more proportionate treatment, and perhaps reviewing and alleviating certain rules that perhaps have been agreed on in the frenzy of the previous crisis, and perhaps making them slightly more fine-tuned and more, let's say, appropriate to the variety of the stakeholders we're dealing with. And I think the role of SMEs and the way how they were hit by the crisis is extremely important in this respect. So making sure that those rules are fit for SMEs, that SMEs can get access to financing, that they can scale up, I think this is going to be essential. Now, one other element that I think is necessary is to, and I think Rainer, you have mentioned it in your press release, is the fact that there is quite a lot of interaction between public support and private markets. And I think, to be honest, without the CMU, without integrated, deep, liquid markets, it would be very difficult for the public support to have a long-lasting effect and to actually reach the right types of companies. In all honesty, it would be even difficult for the EU to raise that kind of money if you don't have well-established channels, if you don't have a good population of institutional investors willing to invest in those instruments that will be issued. So it sort of requires the infrastructure that the CMU seeks to achieve, and only in ensuring that this infrastructure actually works and works at times of crisis. I think we can raise this money, and then we can channel this money to companies. So this is paramount. Now, on the debt equity bias, of course, there has been some work already done by the Commission, in the sense that, of course, it's the Commission's role is important, but perhaps not as important as the role of the member states when it comes to tax. there have been proposals. There has been a proposal on the CCTB. At the same time, I think it's important to realize that this proposal is for the moment in stock in council, and I think that the really the work of the member state is paramount to ensure that I think I hear my own echo, so I don't know whether I hear my. I think somebody. I would ask if people could mute themselves so I don't hear my own echo. Right. So this is the debt equity bias. Of course, incentivizing equity is extremely important. The role of tax incentive is key. There is a limit to how much the Commission can do that as well, because when it comes to fiscal policies, tax incentives, this is a fairly national playground. Of course, the Commission can work together with the member states to enable good practice sharing or best practice sharing, and maybe work on some code of conducts, which we've done also in the past. In the area of the withholding tax, mentioned, I think also by Rosina, all of these issues require very delicate and very sensitive, if I may, approach to them, because of course it's very easy to step on very sensitive points and national grounds. At the same time, if there is a realization that equity needs to be supported, and it needs to be supported not just with regulatory tools or let's say certain prudential adaptations, but also with fiscal incentives, then I think member states should join that work stream. I think as regards what the Commission would do in terms of the follow-up to the high-level forum report, I think what is key is of course to establish which of those recommendations do not only make sense but should be prioritized by the Commission, in particular in light of COVID. So everything to do with really supporting companies to access financing through different vehicles, through different instruments. Also, access to public listing, as mentioned before, is going to be, I think, paramount to any work that we will take in the months to come. I think the support of the member states to the Commission action plan is going to be key, because if the action plan puts forward ideas, but then only for the member states to say that some of these ideas are very nice, but they disagree because they have been disagreeing for a long time before. I think that there's very little chance that we will get anywhere with this action plan either. So I think what I would be calling on, and I have been calling on in all discussions with co-legislators, is to make sure that the member states see the urgency and actually act on this urgency alongside the Commission, alongside the Parliament. So I don't know, I might have not been as precise as you've seen with very specific things, but if there are any questions, I'd be happy to address them. Thank you.
Well, thank you very much. And I maybe would turn to Hannes. And if I look at EBRD, obviously, as per your mandate, you're mostly working with less mature markets. And I think you have ample experience at what works and what doesn't work, and would be very, very keen to hear a little bit your view, Hannes, what needs to be done now.
Thank you very much, Rainer. I think what is very important, as the title of the webinar already says, equity capital markets can be indeed the key to unlock sustainable economic recovery, as we have seen by the requests of our countries' operation, which are indeed smaller countries of the European Union, as well as non-EU countries. Companies need to have available financing options in addition to traditional bank financing. So most of the companies in the European Union are relying to almost 100% on bank financing. But to ensure employment and wealth creation, public equity market offer an excellent option to ensure a proper financing mix between debt and equity. And I think to achieve this, a working capital market union is essential. And I'm very happy. I was very happy when I saw the final report of a CMU high-level forum, because it was very focused, gave practical recommendations, and now all of us hope that it will be implemented also on member state level, because that definitively will support Europe's economic growth and create a level playing field for issuers and investors on a pan-European level, which I think is very, very important. And also the recommendations in the report confirmed almost all of the points which we raised in our European IPO task force report in March of this year. So it seems that the demand from side and the interest from side of the investors and issuers were really clearly reflected in both reports and also the recommendations. So now, as the social and economic impact of COVID-19 shows, there is a need for equity capital during crisis times. And it shows also that that is even more important than before to complement the traditional bank financing. But what is for me all the time a surprise, because we are holding quite a number of IPO workshops for small and medium-sized companies. And the lessons learned here for the companies in reality is raise equity capital on public markets in good times. Don't wait for the crisis. Because we see now an increased demand by companies to raise capital through an IPO. They never considered it before because they were 100% relying on bank financing. So here really my first recommendation would be to the companies, consider equity capital also in good times, don't wait for the crisis. And what for me was really a very good experience, and I think for most of the market participants, is that the crisis has clearly shown that European stock exchange are reliable counterparts for issuers and investors with uninterrupted operations. Even during times of high volatility, public markets have proven to be adaptable and resilient. So that means we can rely on our capital market infrastructure. And also IPO activity declined in April and May of this year. We have seen that specifically green issuances still found investor interest. So the crisis really brings also the chance to green the economy and fight climate change. And we also see that investors are more looking for ESG criteria, companies which are fulfilling the ESG criteria. And well-prepared companies in the right sectors and business models can successfully adjust during the pandemic and will find the right window also here to raise capital on the capital markets. And we have also seen a tendency now to have more remote IPO environment. We see very well working virtual annual general meetings, investor meetings, analyst meetings, and sometimes companies which are still coming back to raise equity capital are shortening sometimes their roadshows to limit the short-term market risk for those who are underwriting the issue. And that is specifically true in the areas of technology, pharmaceuticals, and life science sectors. But what we really ask for is the policymakers to improve the ecosystem for the capital markets, and specifically the public equity markets, to create an environment for improved access to financing, specifically for small and mid-cap companies. And as mentioned before, there is the equity debt bias, we have taxation issues, and of course, cross-border trading, clearing, and settlement does not really work at the level everybody's looking for. And I think here, if the action plan of the CMU will be fully implemented, we will finally reach the goal of uninterrupted services between countries. And there is definitively a need for a specialized micro and small cap fund and pan-European investment benchmarks. And the plans announced by the Commission for an SME IPO fund will hopefully support such development and will also initiate private sector activities to come up with ideas how to provide a capital market instrument which can support even micro and small caps. As EBRD, we are actively supporting the development of a local capital markets, may it be through advisory services, policy dialogue, but also with investments into issuances. And to give you some examples what we are doing, which are already aligned with the CMU action plan, as well as with a recommendation we have in the European IPO report, is, for example, the SME research coverage program, which is currently covering 6 countries in Central and Eastern Europe and Southeastern Europe, and which will be shortly extended by 3 further countries. And we have seen here a great interest from investors, because based on MiFID II, we have seen that small and medium-sized companies are less covered by the research providers. And so we see here an opportunity to close the information gap and to bring back small and medium-sized listed companies in the spotlight of investors. We are also supporting the creation of a hopeful CMU index family to increase passive investments in EU member states, specifically in the smaller ones which are currently not covered by investment benchmarks. And we are also working with the governments in the Baltic states, for example, to design a capital market development accelerator fund, a project which just started. And additionally, I would like to mention the pre-listing support programs and the investor base study, which we are publishing each year. Overall, I think given the COVID-19 outbreak and its negative impact on global economic activities in the short to mid-term, governments around the world will, with the help of IFIs, continue to implement policies and stimulate economies against rising unemployment. At the same time, central banks will inject more liquidity into the financial systems, most probably. And both actions will support capital raising activities of companies with expected increases in IPO activities. But I think Tanya mentioned something very important. It has to be driven by investors and issuers, and subsidies can help to jumpstart it, but at the end it must be a self-sustaining financing environment. And I think that is what we really should try to achieve altogether.
Hannes, thank you very much. And I would turn to Peter now. When I think about Accountancy Europe, I probably not only think about the accounting, but more about also tax. And we had some recommendations. So maybe if you could expand a little bit on that, as well as the other issues you feel.
Thank you, Rainer. And I think indeed it's a unique set of circumstances. I think we've spoken about the COVID crisis. What has become evident is that weak companies with weak balance sheets are the first to fall. So we've seen it over and over in the last weeks. So the urge to strengthen the balance sheets with equity to face crises I think has been more important. I would like to combine that with the loosening of monetary policy. Yes, the governments were absolutely right in loosening monetary policy, but there is a law of unintended consequences that loosening of monetary policy has a tendency of, increasing the debt ratios, increasing leverage, and weakening balance sheets. So I think it's the combination of those two elements that we need to be careful that at that time of crisis, when balance sheets are exposed, companies are exposed, that monetary policy does not favor weakening these balance sheets any further, and that we have more mishaps in down the line. So that's why I think our collective call to strengthen the equity, I think, is so important. So in practice, I think we had a couple of recommendations. One I would like to call out is, we've called it bridge financing. From our market experience, we know that there is a number of IPOs which were obviously put in the freezer in the last couple of months. The small and mid-crowd companies, the pool of shareholders that they currently have does not have access to monetary policy. So, these group of companies are now facing liquidity crunch, struggling to, increase their growth path for the next 6-9 months until the markets reopen. And also, likewise, some of these companies may have to postpone, their plans for 3 years because their growth, scenario has a little bit been damped. Their valuations have gone down. So I think the first call would probably, if we could direct a section of the monetary policy, of the loosening of monetary policy, to bridge financing, to allow, pending IPOs to be financed with a probably commitment or a condition that they can go to equity. Same for companies that are in a 3-year plan or 5-year plan to raise, so that a bigger portion of the liquidity which is pumped into the market goes to companies that have a commitment to go into the equity market. I think that will be very important. The second element, which has been touched upon a couple of times, is tax and debt and equity bias. Again, I hear from all the speakers that we are aware and cognizant of the matter. But again, if you combine loosening of monetary policy on the one hand with the simple fact that equity is tax deductible, interest is tax deductible and equity is not, you creating a mechanism whereby debt is favored and equity is not favored, and I would urge the policymakers to consider that and come up with tax schemes that allow for a certain deduction for amount of equity, a deduction for an equity increase. Mechanisms like that are possible, so that the debt equity bias is therefore reduced, and we encourage the liquidity which is pumped into the market to go to equity. I'm compelled to also call upon the withholding tax matter. Unfortunately, I don't want to use the word penalizing, but I think if you look at the restrictions and the protocols that are needed today to recover your withholding taxes from an investment you've done in other countries, I'm afraid that we probably should use the word penalize, because de facto, before you can recover your withholding taxes, you have to jump to so much hoops that you're effectively at a disadvantage of doing so. So I would again urge regulators and tax authorities to create mechanisms that allow the technical recovery of withholding taxes into a practical and cost-efficient way of recovering your withholding taxes. So I think both these elements are important, and if we want to incentivize all investors to go across Europe investing, I think that becomes more and more important than it has in the past. As Accountancy Europe, we strongly believe and support the Commission's initiatives for sustainability, ESG, and we do think that the measures that we've called out in terms of bridge financing and tax schemes can be easily combined with sustainability criteria or ESG, so favoring those companies that do those efforts and allowing them potential greater tax benefits or better bridge financing. So we do believe these things can be easily combined so that the multiple goals are achieved at the same time. So as a working group and as Accountancy Europe, I think we all look forward to your next CMU paper and believe that hopefully these elements can be picked up, and we'll be keen to work with you to support you and hopefully implement some of these measures that we've just called out. Thank you.
Well, thank you. And with that, I would turn over to you, Sina, to maybe fill us a bit in on CFA Institute and the work you've been doing around these issues.
Thank you, Rainer. And Tatjana, thank you so much for going in quite deeply into CMU. And really, it's such a breath of fresh air that we're all taking CMU as a project in our hands and saying, this is what we need. And also that repeated speakers, you yourself, Tatjana, but also Hannes and Piet and Rene have all mentioned the fact that national member states have to subscribe to it. It is linking the EU to the national agenda. That is the way forward, while taking into account specificities. And I think this is interesting. We have, I'm going to be quoting from a global survey we've done on COVID-19 and what is happening around the world with our members' perspectives. And I would urge you all to have a look at it. It's online. We go from the macro, where we look at the recovery, and our members, I think in the EU at least, think that the recovery is going to be more in the medium term, either a hockey stick recovery or a U-type recovery. So that indicates, you know, we're not out of the woods, and recovery is going to take quite some time. Again, I think what was interesting on this survey, which really happened very recently in the last couple of months, is that our members in the EU are there is a large group of them that think central bank intervention and government intervention was absolutely necessary, but it's going to have to remain in place longer term to sustain the economy. But our German members, for example, are rather more of the opinion that it should stop as soon as possible, and we should return to fiscal rigor. So that shows you some of the challenges that lie ahead. You know, not all countries react and have the same opinions, and our members do reflect that. So again, I think that's important. And when we look at, we as many other people drew up a blueprint for the new Commission's 5 years back in 2019. And when I look at those recommendations, we still stand by them completely. I mean, we raise the fact that policies and incentives need to encourage long-term savers. And interestingly enough, already last year with the intergovernment report, and also, of course, the high-level report, focusing on the buy side, focusing on the end investor, retail participation is necessary. And our group that is present here today has reflected on this, and we've had retail investor associations participate in our brainstorming. So we are completely convinced of that. It's necessary for a good functioning capital market to get them in. Again, what is important is to look at measures that are going to stimulate the smaller companies, the SMEs. So again, this was really a key point for us. And back in 2013 already, we did a survey on SMEs for Michel Barnier. And really there already we could see liquidity was a problem, access to finance, research was a problem. These things haven't really changed. So this is a long-term problem that sort of has been dragging on. And I think we do need to address it. And we need to take a look at the framework of regulation and directives and see, is there any unintended consequences? I remember already in the Parliament, there was a report, I think even at the beginning of the 2014 legislative period, which looked at unintended consequences. Well, that has become supremely important. We need to be pragmatic. In this global COVID survey we did, when we look at regulation, our members clearly cite that policymakers need to adapt the regulatory framework and work together to encourage measures to address the crisis. Not lightening, that is something quite interesting that came up, not lightening necessarily the regulation, but working together in partnership. And again, that's something that I'm hearing quite a lot from policymakers, this desire to work together with stakeholders, with the markets, to really focus on the economy. And this is something that at CFA, of course, our mission is finance for the ultimate benefit of society. So this is really at the core of our DNA. Again, the impact on investment research, it really is quite key. We have done quite a few surveys on MiFID, and our members are divided. Some of them think that, you know, perhaps we should look at the bundling or unbundling and rebundling. Some of them think that sponsored research might provide the answer, but that it has to be quite clearly flagged. some of them also don't think it was a MiFID consequence. And this we picked up in our product governance survey, where we encourage what MiFID has brought in terms of investor protection, and say that perhaps the issue of investment research is not entirely due to MiFID. It may have actually just been a market tendency. And what we had suggested in this product governance survey was for the Commission, for ESMA, to take a look at price formation issues and see really what is the issue in the market itself, what is happening. And I think, again, we discussed this in our task force quite extensively. So for us, we feel that all the issues that were brought up by both Pete and Hannes and Reina, and really these are some of the concerns that our members share and have seen in their own daily lives, let's say. So it is important to see that, you know, there is a general desire. And I think back in 2015 we did a CMU survey when the action plan came out, and our members were completely convinced that there should be a capital market with no cross-border issues. There should be opportunities. Withholding tax was raised. Again, all of these things, we know them. They have been there. And I think it's the first time, at least from my part, and I have been in the EU environment since 2004, it's the first time I feel that member states and the EU at the EU level are pulling together and addressing the issues. Now, if COVID can bring that about, then I'm happy. I'm not happy about the health issues, but I am happy about the fact that finally we are pulling together, whether it's national, to the EU and back again. So that is a good consequence. Thank you.
Well, thank you. And let me maybe just briefly comment for exchanges. I think several of you mentioned that exchanges remained open throughout the crisis, showing the value, I think, of price formation in volatile times. And yes, I think to me, that is probably for a functioning capital market very important that in the critical days, the financial sector was able to stand up and to keep markets open, to ensure, I think, that we had orderly, fair and transparent markets where liquidity and risk could be managed. I think it's also interesting to see that that didn't work in the fixed income markets. So I think when policymakers look back, what has worked, what has not worked in the crisis, I think the lessons is really that we need more transparency. We need to, in my view, really think of getting a tape of record that would cover 100% of markets and would be able to give investors, I think, a guideline of transparency that would show them 100% of what is actually happening in markets. That's currently not available. And I think we need to be also very cautious what happens on bilateral or dark execution venues, because many of them did not work in the crisis. So I think that, to me, is something that we need to pick up and I think really look at this. We need, and that was said, I think, more financing through equity markets to really help achieve higher levels of growth and risk sharing, to diminish the systemic risk. And that's something where Europe already pre-crisis was at a worse situation than, for example, the Americas or Asia, where historically equity funding is higher. I think we need really to make sure that this is a trend where we reverse, I think, the culture that we have in Europe to rely more on bank lending and activate, I think, equity markets to a larger extent. I won't discuss so much equity markets and the crucial role in restoring the solvency of companies. I think you've all covered that very well. Maybe just one comment there. If I look at all the cash sitting on European accounts that bears no interest or at times even negative interest, and if we were able to activate that for the recovery, much of the financing of the recovery would be a very easy process. And that's where I maybe would reiterate the comments made by Pete around tax and tax incentives and equal treatment. I think if we are able to unlock that, and I think the history of, for example, the growth markets, various examples in the Nordics, in London with AIM, etc., have shown whenever tax incentives are provided to go into equity, they're quite powerful to activate retail and investor participation. And last not least, the EU IPO fund, I think we of course fully support it. That public-private fund, I think, comes at the right time. We think it's important that it also will support secondary issues, and obviously it's important to contribute to IPOs, but also we need to look at listed SMEs that need to tap into additional funds in the market. So I think that's an important element we think that would have to be added. And overall, the European Recovery Fund to rebuild a sustainable and resilient EU economy, in that view, I think is going to be a major contribution in my view. I would maybe ask my fellow panelists, Tatjana, any reactions to what has been said throughout, and any further comments to be made?
Well, thank you very much. Maybe I'll just comment briefly. I found the report from Jusina very, very interesting on a couple of issues, including on the issue of research. I think there is a wide agreement amongst everyone that there is a problem. I think there might be some disagreement about what the solution should be, whether it's because of unbundling rule or not because of the unbundling rule. And if there was no research even before the unbundling rule was introduced, would rebundling help the issue? Would there be actually more research for SMEs or not? Because ultimately this is what should matter. Would we have more SME research coverage or not? So I think these are all valid points. The point on withholding tax mentioned several times. I think one way is indeed to simplify the procedures and ensure that it all works. Another way is actually to go for maximum relief at source, because that could be also a way to tackle the problem. But that requires a lot of trust between tax authorities, because one of the difficulties, I think, is the fact that that there is a big risk of tax fraud and tax evasion, and I think that's why you have the system the way it is now, and that's why I think some exchange of information between tax authorities is going to be key, and I think that there is quite a lot of potential to work in the direction of bigger relief at source and more streamlined, I think, forms, if not a single form across the EU, to make sure that these processes, because these are ultimately just administrative processes, and if they really become a decisive force when investors are looking for cross-border investment potential or opportunities, I mean, I find this scandalous. So we need to find a solution to this, and of course, tax is complicated, as are many things, as is insolvency, as is company law, as a lot of other things. On the IPO fund, this is something I haven't mentioned, and I think indeed perhaps I should say something, because this is a Commission initiative, and this is something where I think we can really try to anchor investment, support investment in SMEs. And I think this private-public initiative might actually carry a lot of weight and potential, but of course everything would depend on the size of the fund, on the ability to crowd in private investors. And on the one hand, the fund becomes extremely timely, because there is a huge need to support companies, huge need to re-equitize companies, but at the same time it comes at a time when I think private investors might be slightly more timid compared to the pre-crisis situation, and therefore crowding in of private investors might be more complicated. So I think what is important in the ultimate setup is to ensure that whatever the structure is, it works. It has the maximum impact on the market. It supports institutional investors, and it supports ultimately SMEs, because this is the ultimate objective. And I think that the fact that it really focuses on SME IPOs, where the problem is really, really acute is important for all of us to accept and to embrace. And I think the solution also cannot be only national. And we see that there are some promotional banks initiatives popping up, which are extremely good. But I think the solution should be pan-European, because if you want to also fight the home bias, which is still fairly prevalent in Europe, I think we need those pan-European structures to support that. So maybe with those few remarks, I would end my reaction to your points, which I found very, very precise and I think very appropriate. Thank you.
Any reactions from the other panelists?
Maybe just one point, and I think, Tatjana, you put absolutely the finger on it with the IPO fund and very realistic. I think also what's been really interesting is the creation of a new Director General reform, which is going to help this public-private combination. I was very heartened to see that, our CFA societies were coming to me, maybe from Cyprus or from other countries, saying, we're working with the ministries of finance. We've heard about, the fact that, working together, reforming the capital markets. You really feel there's like a snowball effect. And it seems as if everybody is taking their shovel and digging up the snow and starting really to do something. And that I find extremely encouraging.
And maybe from my side, I think on the the cold water fear for the investors to step back into the market, Tatjana. I think there's no one silver bullet that will fix any of these things. But I think if we start combining, the liquidity into a fund, and we add tax measures to it, we allow the withholding taxes. We create sustainability measures around it, which the investors want, the market wants it. So I think if we combine multiple layers, then I think the attractiveness of the package, I think, becomes such that the cold warfare might be overcome. And I think the packaging of these multiple layers, I think, will be the convincing element for people to actually, from the investor side, step in, and also from the issuers to find the package enough attractive to do whatever they need to do to then take the next step in their financial maturity. So I would encourage the combining of multiple features to make it a really convincing element. I appreciate that I'm making things more complex, but I think I rest my case.
Hannes, any final words?
No, in reality, everything was said, but what I really see is that there is a new spirit also on member state level, really seeing capital market as one of the solutions to help in the economic recovery. And I think that really creates a window of opportunity. But I'm now in capital markets since 25 years, and what I've seen is the government gives it, the government takes it. So without government support, and that doesn't mean that the government has to provide financing, but creating the framework which enables the private actors to develop the capital market and to use it properly, and that includes tax incentives as well, really helps. But I think the main task for the Commission and the challenge will be to bring everybody in the same boat and have an orchestrated action when it comes to cross-border taxation, for example.
No, thank you very much. Let me maybe just highlight again a little bit what has been the recommended measures, and I think what we've been discussing today. I think we think collectively a revamped CMU which balances really private and public markets is a must. We think that the proposed fund for EU IPOs should be pan-European, and I think, Tatjana, you've resonated that as well. We need to support both IPOs and secondary issuances while, I think, contributing to relaunching IPOs. To re-equitize the economy, a concrete proposal for the fund through public-private partnership should be drafted, and that's my understanding. You're quite heavily working on that, so I think that's extremely important. The various stimulus packages should include specific bridge financing for viable SME and growth companies that were planning IPOs when the COVID crisis hit. And obviously all the taxation issues that Pete, I think, very skillfully laid out, the debt equity bias, withholding taxes, tax alleviation for companies that go public, do an IPO that could be considered, as well as, I think, obviously the E in the
We have a frozen speaker.
Rainer, I think you're blocked. Maybe if you take off your video. Okay.
And there I was disconnected in my final words. Sorry very much. I don't know where I dropped off. I was talking, I think, about the E, the sustainability. That was my last point. So thank you very much for everybody participating, and we'll see each other shortly and continue working on all the issues.
Thank you very much.
Thanks a lot.
Thank you.
Bye-bye.
Bye.
Bye.
Thank you very much. Bye-bye.